As we approach the end of July, you'll start hearing this familiar phrase again. The U.S. is heading for a debt ceiling crisis. But here's the twist. What if I told you the real risk isn't in a default, it's in the deal itself? Because once an agreement is reached, the U.S. could unleash over $2.1 trillion worth of government bonds into the market. This has never happened before in American history, and this could shake global markets even more than a potential default. Let's break it down.
First, the so-called X date, the day the U.S. might technically default, is expected to hit in early August, likely around the 4th. So Washington needs to finalize the debt ceiling deal before then. Now, back in 2018, under Trump's first term, the U.S. government shut down for 35 days over a similar issue, the longest shutdown in U.S. history. But this time, the danger isn't the negotiation breakdown, it's what happens after the deal is done.
Since January 1st, 2025, the debt ceiling was hit at $36.1 trillion. Yet the Treasury hasn't issued a single new dollar of debt above that limit, because they used accounting tricks. First, they pulled nearly $470 billion from the Treasury's general account. Then they borrowed over $540 billion from federal employee pension funds. That's over $1 trillion raised without issuing any bonds. That's how they stalled the market and kept 10-year yields around 4.3% instead of shooting past 5%.
Here's the math for the second half of 2025. Repay the $540 billion from pension funds, refill the Treasury General Account, TGA, by $700 billion, cover the projected $1 trillion budget deficit, and issue the $1 trillion in bonds that wasn't issued earlier. That adds up to at least $2.1 trillion in new bond issuance, unleashed in just a few months. A historic event that'll echo across global markets. Remember June 2023? Another debt deal signaled issuance of $1 trillion. The result? The 10-year yield spiked from 3.4% to 5.0%. That 160 basis point leap rattled markets worldwide. Now we're starting at 4.3%, which means yields could surge again, or worse if issuance continues. In 2023, there was a safety net, the Federal Reserve's $2.1 trillion reverse repo facility. Treasury Secretary Janet Yellen redirected all that to shore up bond demand. Now, the reverse repo war chest is empty. So, Treasury Secretary Bessent is left trying measures like easing bank capital rules so banks can hold more bonds. But banks only account for about 7% of the market. The next is encouraging stablecoin investments in treasuries, but the problem is the stablecoin market is only about $230 billion. Both are interesting, but far smaller than the mountain of debt needed. All emergency tools have been used. The flood of $2.1 trillion in bonds is imminent. How the bond market reacts could reshape global interest rates and financial stability. So here's the takeaway. Don't just watch the debt ceiling headlines, watch what happens after. When $2.1 trillion hits the market, interest rates could surge over 5%, markets could destabilize, and central banks worldwide will feel it. If this breakdown was helpful, please hit like and subscribe. See you next time.